Now we should stream. Oh, it is stream. Nice. Okay, yeah, it is streaming, so that's good. Fuck it, this camera SOS! Okay, yeah, it is streaming, so that's good. Okay. Dude, this camera angle is so ass. I don't want to go. No, fuck it. Man, Linux is so kind of weird, but it's really stable. Here you go. Yeah, I'm not interested. There you go. Okay. God, I'm so sorry. The background noise is so ass. There you go. That should be. It should be fine. Okay, first thing first, I need to calculate. Okay, first thing first, I need to calculate. I'm sorry. The fucking background is bad. Nulis Anaconda. Bagus. Hello. Hello everyone. Hello everyone. Oh fuck, that's crazy.
What?
I think the stock market's already open. Yeah, stock market's already open. It's 8 p.m. right now. 17, there you go. Should go down. Future. I have 17 days left. So if I spend like around, just in the worst case scenario, it's per day. Shit going on there. Okay. If I spend like 64.5 on a daily basis, that means I estimate to be on 17th day left. So I shouldn't be that optimistic because I'm gonna. Yeah, so let's go with a future high projection of 70,000 rupiah per day. So this is our standard. Let's get this. I still have cash. I still have GoPay. GoPay is like really low, it's like only 100k. So it's not that much. Okay. Cash is made up like around half of the stuff, but cash is still king. So I'm projected to be 17 days, but it's probably less. Like let's see, my balance right now is 1126 divided by 70. It's 16 day. Okay, so it's only like 1 day different. Wait a second. The fuck is called? Window capture. Window 1. Okay. Select. Focus. There you go. It's because it's it doesn't matter. If it's good enough, it's good enough. There you go. Not the most ideal, but it's good enough. Okay, so 16 days, that means on the next month there is gonna be 30 days, so 16 days, so 14 times 70, it's 1 mil. Okay, so 1 mil for expenses, and then like 1 mil investasi. Okay, I cannot budget. I mean, I can, but if I live really frugally, but it's gonna be next month. Okay, so how do we distribute this cash? If I look at blue, how much money do I have? How much money do I have? also have a coffee with me. So 126 478 on blue. I don't think I have this much money. How do I have 1 mil? Okay, wait. Okay, it's only 60 on GoPay, and the rest is on cash. I still don't know what's this number. I need to recalculate the cash number. So if I do the math, 478 123 plus 60 minus 1126 588. There's no way I have that much money. Okay, I still do have some. I mean, I just spent like $1 billion. Okay. 200 200 1 2 guessing 300, so 248 di Bogor. That's an estimate. Okay, that's kind of crazy. Oh, I should have much money, but okay. Definitely not in blue. So expenses for it's gonna be 50% on cash, 50% on GoPay, or maybe 40-60. Just to be safe, I'm gonna go 50-50. Okay. That's good. I think it's okay, net worth is very calculated, so that's cool. I should I don't know how long they will recover though. It should take a while, like 1 or 2 years. Okay. Am I streaming on Twitch? Okay, yeah, it is broken. This video is need help. I don't know why the fuck is there something wrong here. Why the fuck is it on, right? Offline? Bro, this fucking website is so ass. Okay, it should be streaming now on Twitch. I don't know why it's broken. It's broken on Twitch. Yeah, I don't know how to fix that on Twitch. Yeah, just straight off. I fucking hate this shit, bro. There you go. So annoying. Does it matter that? Let's see. Is this? Wait. XG boost. The fuck is the Chrome? Let me just do this, right? Give me a second. Just make it shut up. There you go. What's this video? Good at critical thinking.
The Polish. Okay. Oh shit.
work fine. Okay, everything should be set. And yeah, let's go start study. Where is my chopper book? My child. Okay. What the fuck? Chat Jai Pai Tai. Fuck you. Let's go to file. I need to fix that fucking Twitch. I don't know why the fuck is it broken. But I'll set a break. I'm gonna. That's it. Okay. Let's do okay, so I did ethics and professional standard, quantitative method, economic, portfolio management, derivative investment. I have an alternative, debt, equity. So 1, 2, 3. Alternative investment, financial statement analysis. I think let's go financial statement analysis. It's a lot of material, so let's go. Okay. Analyzing income statement. Okay. Before that, I'm just gonna economy PDF financial statement. Okay, what is the big picture that is presented in that material? Give me just the keyword. In that PDF, in the PDF that I've attached, giving just what is the big picture that is presented in the PDF that I've attached in this prompt. Give me just the keyword. Okay. There is 41 slides, so there's a lot of slides that we need to read. So let's go. I want to skim through this material. So revenue recognition, let's see, expense recognition, capitalization, EPS. Okay. Are you fucking kidding me? Try again. I'm bombing the fuck out of you, bro. What the fuck? Just so. Oh, it's 1B. This is 1A? No, this is 2. What the hell? Give me a second. Financial statement. Financial statement analysis introduction. Why the fuck is this not downloaded? I don't know. Economy. just it exists, but let's do this now. There you go. Okay, so let's just do this. Okay, I forget to turn this thing on. Let's turn the Pomodoro timer on. Okay. This is the PowerPoint Introduction to Financial Statement Analysis. Describe the steps in financial statement analysis framework. State the objective and context. Gather data. Process the data. Post adjustment. Analyze and interpret the data. Report the conclusion or recommendation. Update the analysis. So it is like always like it is a revolving thing where every day you have to look at new stuff. Okay. Well, position to make informed economic and investment decision. Here are the core themes that make up this big picture. The analytical framework. Financial analysis is not random. It is a structured 6-step process. This involves stating objective, gathering and processing data, analyzing the information, reporting conclusion, and continually updating the analysis. Looking beyond the primary statement. A significant portion of the document emphasizes that true analysis requires digging into supplementary information. Analysts must read financial statement notes, footnote to understand the accounting methods and assumption used. Review management commentary (MD&A) for insight into business objective and risk. And check proxy statement for details and board member and compensation. The importance of audits. The document highlights the necessity of independent auditor report to verify that financial statements are prepared in accordance with accepted accounting principle. It details the different types of auditor opinions analysis might encounter, ranging from unqualified, clean, to adverse, not presented fairly. Navigating regulatory difference. The presentation underscored the financial reporting standards are not strictly universal. Analysts must exercise caution and understand the difference between the rule-based US GAAP set by FASB and principles-based IFRS set by IASB, as this framework dictates different treatment from items like inventory valuation and product development costs. Diverse information sourcing. Finally, it established that analysts cannot rely on financial statement alone. They must gather context from a wide variety of sources, including company earnings calls, government economic statistics, proprietary data platform like Bloomberg, and commission primary research. In essence, the documents serve as a roadmap from an inspiring financial analysis that detailed how to systematically process financial data, where to find the complete story hidden in the footnote and supplementary reports, and what regulatory difference to watch out for when a company comparing. Okay. The thing that I don't understand is the stating objective. That makes sense. And okay, there are not that many slides because I think it's just like, oh, you should learn this, blah 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 blah. Okay. In the financial system analysis framework, the very first step is state the objective and context. This is crucial because you cannot analyze a company effectively if you don't know exactly what you're trying to achieve and the circumstances surrounding your decision. The objective defines the specific question you're trying to answer to make an economic decision. Weak objective: analyze the company financial health. Okay. Describe the role of financial statement analysis. Financial reporting. Present the company financial statement to investor, creditor, and other parties to provide information about the financial position, performance, and change in financial position that is useful to a wide range of users in decision making. Financial statement analysis. Utilizing the information in financial statement along with other relevant information to make economic decision. Economic decision comprise of investing in a company instrument, recommendation to investor, or whether to lend money to the company. Analysts use financial statement info to evaluate a company past performance and current financial position to build opinion about ability to earn profits and cash flow in the future. Okay. Describe the importance of regulatory filing, financial statement, notes, and supplementary information management. Standard setting bodies are professional accountants and auditors that set up financial reporting standards. Regulatory authorities are government agencies that have legal authority to enforce compliance with financial reporting standards. The two primary financial standards are FASB and IASB. Financial Accounting Standards Board in the U.S. International Accounting Standards. The US FASB established general acceptance accounting principle (GAAP), also US IFRS. In Indonesia di SAKIAA, Pernyataan Standar Akuntansi Keuangan. Pesak. Okay. No material omission in error file. This material is so boring. Okay. So, I don't know. I don't like the material at all. Okay. Okay. 1B. I'm gonna ask the same thing. What is the big picture? I hate this shit so much. I want to throw this phone away, bro. Based on the provided presentation, CFF exemplary, the big picture of this division is the technical deep dive into how an analyst must dissect and interpret company income statement. Okay, so it's all about income statement. This is an important part. This document emphasizes that recording revenue and expense is not as simple as tracking cash in and cash out. It outlines strict 5-step process for recognizing revenue, highlight complex scenarios like long-term construction, contract acting as a principal, as agent, franchising, income statement, structure, and normalize make a sense of this format, analysis, measuring the shareholder value (RPS). A massive portion of the document is dedicated to understanding earnings per share, which is the most commonly used corporate performance statistic. It breaks down critical difference between basic EPS and diluted EPS. I'm so confused. Okay. I think just so I think for me it should attach how an analyst must dissect. Let's start simple. Let's start simple. What is the income statement? Can you give me a perspective of what is it from a value and growth, value, investing, growth, investing, and quant. Perspective. Why the fuck is it so laggy, bro? Because I'm streaming, that's fucking why. Alright, fine. At its most basic level, the income statement, also known as a profit and loss. What? It's a P&L? It's a P&L statement? I've never heard that before. So company financial performance over a specific accounting period. It provides a step-by-step calculation that starts with the total money brought in from sales, subtracts various costs to arrive at bottom line income or the earnings, the final profit after including interest, tax, and non-recurring items. Okay. Different investors look at the exact same income statement but focus on very different lines to inform their decision. Value investing, the safety perspective. Value investors hunt for a company trading for less than the intrinsic value. They treat the income statement as a tool to find sustainable, boring profitability. Focus, they prioritize operating income. What is operating income? Profit after subtracting regular business around like rent and salary. So I'm guessing it's not with taxes as well, so this is considered the best indicator of future earnings. The filter, they are highly skeptical of unusual or infrequent items or extraordinary items that might artificially inflate the bottom line for a single year. Goal, to find a company with a high EPS relative to its stock price, low PE ratio, instead they are overpaying for those earnings. Growth investors care less about today's absolute profit and more about the speed and scale of expansion. They start at the very top of the revenue growth. If revenue isn't expanding rapidly, it's really a growth stock. They reinvest. They look at research and development R&D costs under US GAAP. These are expensed immediately, which lower current net incomes but suggests the company is building future modes or products. Goal, to identify companies that can capitalize costs effectively to build long-term assets that will eventually dominate the market. The data perspective. As someone who is interested in backtesting and financial modeling, you likely view the income statement as a set of standardized inputs for a factor model. A quant look at earning quality. They might compare net income to cash flow from operating CFO to see if the company is aggregating profits through aggressive revenue recognition. A quant will look at the impact of capitalizing and expensing since capitalizing costs might make sense. Okay. Okay. Okay, wait. Earning before tax. What is EBITDA again? EBITDA. Earning before interest, tax, depreciation, and amortization. Is operating income also called EBITDA? Operating income is a formal accounting measure found directly on the income statement, while EBITDA is a non-GAAP financial metric often used by analysts to evaluate pure cash flow potential. EBIT. So this is before depreciation and amortization. Okay, so EBIT. Namanya sama semua anjing. Okay. The recognition of revenue is not, however, Okay. The recognition of revenue is not how. What the fuck is this sentence? If a sales of a goods is made on credit, revenue can be recognized at the time of sales. An asset account receivable is created and on the balance sheet. What the fuck is this? The recognition of revenue is not, however, what the hell? What is this? Is dependent on this. It's not accrual accounting, which is the standard for the CFA curriculum and most global financial reporting. In simple terms, it means making a sale and getting paid are two different events in the eyes of accountant. Under the accrual method, revenue is recognized when a company satisfies its performance obligation. Essentially, when it does the work or deliver product it promised, it does not matter if the customer has handed over the cashier. Okay. Oh, okay. There are two types of okay, I'm just gonna watch a fucking video, bro. I don't have any fucking accrual accounting. There's this goated guy. Okay. Oh my god. Oh my.
That's you. You'll need to use the accruals basis of accounting instead. This week, the accruals basis. Hey guys, welcome back to Accounting Stuff, the place where we discuss all things accounting. Up until now, we've been talking about some basic accounting theory. Last week, we talked about the cash basis of accounting, and this week, we're going to talk about another super important method of accounting, the accruals basis of accounting. The accruals basis of accounting is considered to be a much better method to follow than the cash basis, because there's so much information you can extract from it. I'm going to explain why. Most businesses, when they're starting out, tend to cash account, because it's easy. But have you ever wondered how the big companies like Apple, Amazon, and Google do their books? Or pretty much any household name. They all have one thing in common. They use the accruals basis of accounting. If you've never heard of it before, don't worry. I'm going to explain it all to you right now. Don't forget to stick around to the end because I'm going to talk through some of the main advantages of using this method and also the reasons why most businesses starting out tend not to use it. Let's get cracking. In the last video, I explained the pros and cons of the cash basis of accounting. If you missed it, there should be a link somewhere up here. With the cash basis, you record your revenue once you receive the cash and you record your expenses when you pay that cash back out. It's a great way to do your books and it's simple. And that's the reason why it's an approach used by many small businesses and individuals with personal finance.
I think let's start with cash counting first. Oh my god, it's so loud.
In this video, you'll learn what the cash basis of accounting is, why loads of people use it, and what the pros and cons are. Hey, I'm James, and welcome back to Accounting Stuff, a channel dedicated to all things accounting. In today's video, we're continuing our series on accounting basics. Today's topic is the cash basis of accounting, which is a handy way of doing your books if you're a small business owner. If you haven't heard of it already, you may in fact already be using it. Don't forget to stick around to the end of this video, because I'm going to be sharing all of the pros and cons of this accounting system, and I'm starting right now. The cash basis of accounting is a method of recording financial transactions. Under this method, transactions are only recorded once cash changes hands. We record revenue only when
Fuck.
cash is received.
Really? Is break already? Fine. What the fuck is it called? Shit. Okay, timer should be up. But give me a second. Oh, it's 1 second, so. Okay. Yeah, let's give it a second. Okay. I was just trying to fix the fucking Twitch shit. I don't get it. Why is it broken?
And we record expenses on account goes. I'm going to be sharing all of the financial transactions. Under this method, transactions are only recorded once cash
Fuck you,
changes
Bethel.
hands. We record revenue only when cash is received, and we record expenses only when cash is paid out. Let me elaborate on this with a simple example. Imagine you've got a baking business and a customer places an order for a birthday cake. The ingredients for this cake cost you $10 to buy, and you are selling it at a 150% markup on cost. Let's on this with a simple example. Imagine you've got a baking business and a customer places an order for a birthday cake. The ingredients for this cake cost you $10 to buy, and you are selling it at a 150% markup on cost. So the customer pays you $25. You've got two transactions to record. First, you need to record the expense, which in this case is a cost of buying the ingredients for the cake. You debit your expenses by $10 to increase them, and you credit your cash by $10 to reduce your cash balance. You then need to recognize your revenue, which is the $25 that the customer pays you. You debit your cash by $25 to increase it, and you credit your revenue by $25 to increase it as well. If you're new to debits and credits, or you'd like a refresher, I recommend that you check out. Your business has 7-day payment terms, so you receive the cash a week after you baked and handed over the cake to the customer. Under the cash basis of accounting, you record your expense the day that you bought the ingredients for your cake, and you recognize your revenue the following week, on the 1st of November, because that's when you received the cash from the customer. So, what are the pros of using this method? For one, it's a great way to record transactions of small businesses that deal and operate mainly in cash. It's simple and easy to understand, so your business doesn't necessarily need to hire an accountant or someone that understands more complex accounting methods. That makes it cheap to maintain, and you might be able to get away without paying for more pricey accounting software. And finally, many countries accept this method of accounting for tax purposes, so long as your earnings are below a certain threshold. So this could be a viable option for you. Now you might be thinking, wow, this sounds amazing. Why doesn't everyone do it? Well, in reality, most businesses are much too complex to use this method of accounting. When you cash account, you don't have an accurate way of recording your profits, so there can be huge fluctuations in your results. This is caused by recording income and expenses in separate accounting periods. If we go back to that second scenario, we can see that we recorded the expense in October and the revenue in November. So the October accounting period would show a loss of $10, and the November accounting period would show a profit of $25. It would make much more sense to show a profit of $15 in October, because that's when the work was done, in addition to dollars. It would make much more sense to show a profit of $15 in October, because that's when the work was done. In addition to this, you have no way of knowing your financial position because you aren't recording your payables and receivables. Finally, and this can be a clincher, the cash basis of accounting isn't allowed under GAAP or IFRS.
Yeah.
So if you follow either of these principles or standards, then no dice. So the cash basis of accounting can be a great way to record transactions if you've got a small business that relies solely on cash. However, if your business has payables and receivables, this method probably won't work well for you because timing differences between cash in and cash out mean you don't have a reliable way of recording your profit. If that's you, then you'll need to use the accruals basis of accounting instead to match up those revenues.
But I still get it.
It probably won't work well for you because timing differences
Timing difference.
between cash in and cash out mean you don't have a reliable way of recording your profit. If that's you, then you'll need to use the accruals basis of accounting instead to match up those revenues and expenses. I'll take you through this method in the next episode of Accounting Stuff. Thank you for watching today's video. If you found it useful, you can help support
Very
the channel by
interesting.
cash basis. You record your revenue once you receive the cash, and you record your expense. Don't worry, I'm going to explain it all to you right now. Don't forget to stick around to the end because I'm going to talk through some of the main advantages of using this method, and also the reasons why most businesses starting out tend not to use it. Let's get cracking. In the last video, I explained the pros and cons of the cash basis of accounting. If you missed it, there should be a link somewhere up here. With the cash basis, you record your revenue once you receive the cash, and you record your expenses when you pay that cash back out. It's a great way to do your books, and it's simple, and that's the reason why it's an approach used by many small businesses and individuals with personal finance. However, there is one big problem with this accounting method. It can be really hard to work out your business's profitability, particularly when you want to work out how much profit you made for one particular point in time, like 1 month of the year, for instance. And that's because of the timing differences between when you recognize how much profit you made for one particular point in time, like 1 month of the year, for instance. And that's because of the timing differences between when you recognize your revenue and expenses. I'll give you an example of this in a moment. The accruals basis of accounting solves this issue. Revenue is recognized as it's earned, and expenses are recorded as they are incurred. It's a way of recording the substance of transactions, and that makes it a much, much easier way to record the performance of your business over a specific period in time. Let me explain. Let's go back to that example of a baking business selling a cake that we discussed in the previous video. The ingredients of that cake cost us $10 to buy, and we sold it for $25. That leaves us with a profit of $15.
Yeah.
Now, let's imagine a scenario where we sell a cake to a customer on the 25th of October. The customer has 7-day payment terms, so we don't receive the cash until the 1st of November. Under the cash basis of accounting, revenue will be recognized on the 1st of November.
Okay, yeah, so because... Okay.
Because that's when we receive the cash. However, under the accruals basis of accounting, the revenue
Yeah, okay, yeah, no.
will be
Revenue.
recognized on the 25th of October, because that's when the substance of the transaction occurred. That's when we physically handed over the cake to the customer. Now,
Okay.
let's also imagine that we baked that cake using ingredients that we purchased a month ago in September. Under
Okay.
the cash basis of accounting, we would have recorded the expense in September,
Yeah.
because that's when we paid the cash for the ingredients. However, using the accruals basis of accounting, we would instead record that expense in October, because that's when we sold the cake. You can see that under the cash basis of accounting, we recorded a loss of $10 in September and a profit of $25 in November. This timing difference that you can see here could cause us a real headache if we wanted to look back in time and review our performance in October, because we wouldn't see any profit there. It might not seem that complicated for this one example, but imagine that we sold 100 cakes and they all had timing differences just like this one. It would be a nightmare to work out our profitability for a particular period in time because we didn't record the substance of the transactions as they were incurred. However, the accruals basis of accounting neatly solves this issue for us. We record both the revenue and expense in October, so we can see the profit of $15 in October, just like you'd expect. Our revenues and expenses are aligned with each other in the same accounting period, because in the accruals basis of accounting, we apply the matching principle. The matching principle simply states that revenue and all expenses incurred in order to generate that revenue need to be recognized in the same accounting period. This is a key differentiator between the cash and accrual methods of accounting. The matching principle makes it easier for us to objectively analyze results because you can accurately measure your profit over time. Now that we've clarified the accruals basis of accounting, let's run through some of its pros and cons. First of all, like I just said, it applies the matching principle, so a business's profitability can be accurately measured for specific time periods. It also measures accounts receivable and payable, so you can build a picture of your financial position. And it's accepted under GAAP and IFRS, so it's possible to produce financial statements under these principles and standards. On the other hand, however, the accruals basis of accounting doesn't explicitly track cash flow, so this needs to be calculated separately using the direct or indirect method. It's also more complicated than the cash method of accounting because you have to make estimates and assumptions. This can be unsuitable for small businesses, hence why many of them choose to adopt the cash method of accounting instead. If you're deciding which of these methods to use for your business, then you'll need to weigh up the pros and cons of each in order to come to a decision. Both of these methods are usually allowed for tax purposes, although the cash basis is normally only an option if your revenues are below a certain threshold. You can Google what that threshold is on your tax authority's website. It's also important to note that whichever method you choose could impact your tax payments by bringing them forwards or backwards, depending on your situation. However, in the long run, both the cash and accruals methods tend to produce the same result. Most startups and small businesses tend to start off with the cash method of accounting because it's easier to apply and it's a good way to track cash flow. However, if and when those businesses continue to grow, there may come a point where it makes sense to make the switch to the accruals basis of accounting instead. That's all for today. Thank you for watching. If you found this
Okay. Interesting. Okay. The recognition of revenue, however, depends on listening cash payment this account. Revenue can be recognized at the same time of sales and asset. Account receivable is created on the best. There's also like income statement and also like the balance sheet. I forget about that. Expense recognition. Receivable and in accrual accounting, the balance sheet serves as the holding station for an economic action that happen involve cash out. An account receivable is a specific primary tool used to track those actions. When you satisfy a performance obligation, but the customer haven't paid you yet. Wait, I'm so confused. When you satisfy a performance obligation, deliver a product or a service like selling a cake, right? But the customer hasn't paid you yet because, for example, they buy it on November, right? Accrual rules require you to record the revenue immediately on the income statement. To keep the accounting equation balanced, you simultaneously create account receivable on the balance sheet. The effect, your balance sheet assets increase. Now, what the fuck is a balance sheet? Is this called like account? Receivable. Okay. The relation between the balance sheet. The balance sheet acts as a bridge between different periods under accrual methods. Asset side. Beyond account receivable, balance sheets hold prepaid expenses, the cash paid for benefits did not use it. Okay. Okay. Think of the balance sheet as a financial snapshot of exactly what a company owns and owe at a specific moment in time, while the income statement shows you the story on how much money was made over a year. The balance sheet shows you the status of the company health on a very last day of that year. For an investor, balance sheet answer one fundamental question: how is this business funded, and is that funding sustainable? What the company has resources used to generate future profit like cash, inventory, and property. What the company owes other obligations to outsiders such as bank loans, unpaid bills to supplier, or unearned revenue, prepaid for customer for work not done yet. Shareholder equity, what is left for you, often called the book value. It is the net worth of the company that belongs to the owner and all the debts theoretically paid off. After all the debt, okay. Investor perspective, depending on your style, you use balance sheet to look for the different signal. To value investor, the margin of safety. This is like probably the most important part because it's like how healthy the business is. Look at the balance sheet, see if the company is cheap relative to You look at net asset value. If a company's stock price is lower than its equity book value, it might be a bargain. Risk check. They check the debt to equity ratio to ensure the company isn't drowning in loans that could lead to bankruptcy. The growth investor, the engine room. Growth investor wants to see how the company is investing in itself to scale. They look for capitalization, the company's quant budget factor like return on equity or return on asset. They look for accrual. If accounting receivable money owed by a customer is growing way faster than sales, a quant model might flag this as a low quality earnings because the profit isn't turning into actual cash. Leverage to monitor debt to equity. Okay. The balance sheet is bridged, for example, when you record revenue but don't get cash, you create an account receivable. When you pay for more than the last 5 years, this is so confusing. Okay. If the payment for the goods is received before the transfer of the goods or service, a liability. If a payment for the goods is received before the transfer of the goods or service, liability and revenue is created when the cash is received. Why does it create liability? I don't get this. This paragraph describes a scenario where a customer pays a company upfront before any work is done or a product are delivered. This is essentially the opposite of sales on credit, where the product is delivered first. What it means, in accrual accounting, you cannot record revenue on the income statement until you have until you have actually earned it by fulfilling your promise to the customer. If customer hands you cash, you have until you have actually earned it by fulfilling your promise to the customer. If a customer hands you a cash today for a service you won't provide until the next month, you have the cash. So I'm guessing in the balance sheet that the cash goes up. You have the obligation you now owe the customer, so cash goes up and liability goes up. Yes, this is specifically transaction takes place on the entirety on the balance sheet. At the moment the cash is received, the income statement is not affected. At the moment the cash is received, the income statement is not affected because the company has not yet satisfied its performance obligation. Here is the double effect on the balance sheet. Asset side, your cash accounts increase. Liability side, a specific amount are called unearned revenue, sometimes called deferred revenue, is increased by the same amount. Why is it liability? You may seem counterintuitive to call the saving money liability, but in accounting, liability is an investment obligation. Okay, I need to fucking pee. Give me a second. Okay. So this is basically saying, so the slide is basically saying when is a revenue is recognized, right? Okay. To cover, identify 5-step process for recognizing revenue. Identify the contract with the customer. Identify the separate or the distinct performance obligation in the contract. Determine the transaction price. Allocate the transaction price to performance obligation in the contract. Recognize revenue when or as entity satisfies its performance obligation. So, okay. obligation. Okay. Bill and hold again. Performance obligation is a promise to deliver a distinct good or service. Identify the separate or distinct performance obligation in the contract. A performance obligation is a promise to deliver a distinct good or services. A distinct good or services is one that meets the following criteria. The customer can benefit from the good or service, the goods and or services on its own or combined with other resources. The promise to transfer the good and services can be identified separately from any other promises. A transaction price is the amount a firm expect to receive from a customer in exchange for transferring. A firm should recognize revenue only when it is highly probable that it will not have to reverse it. For example, a firm may need to recognize a liability from a refund obligation. Refund obligation. I don't get this. What is this for? I don't get it. This is gonna take me forever, bro. Oh, okay. There has to be a better word for this. Right to return good. This is part of the offer. If a customer returns a product, the company gets the physical item back. The item has value because it can be resold. Therefore, the company records offsetting asset, represent the value of inventory they expect to get back from those under. What the fuck? As an investor or quant developing a built-in model, this is a quality of earning checks. Aggressive accounting. A company might ignore potential return to report higher revenue today, only to have to reverse it, report loss or lower sales in the next quarter. Reliability. If a firm say they cannot reliably estimate returns, they are allowed to recognize the revenue yet. This often happens when a new product launch when there is no historical data. In short, this rule prevents company from stuffing the channel, sending out more goods than they expect to keep sold to just make their quarterly target looks okay. Oh my god. My brain is fried, bro. I need to stop. My brain is fried. settings, output. Oh, I see. Wait, okay. I'm gonna stop streaming.